Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial opinions, and make your own financial decisions. Today is Wednesday, December 14th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to visit our 1% trades this week. We got another 1% trade to tell you about. But before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there, say hello to myself, Viper. Let us know what you're trading. Let us know what kind of content you want to hear about. It is free to join. Also, you can find each and every one of my trades on thetagang.com/sprocket888, the good, the bad, and the ugly. This episode is also available wherever you get your favorite podcast. Be sure to search for us there and subscribe. And if you can't find it, let us know and we will get it there. But let's hop to this week's content, Viper. Viper, big week this week so far in the market. A lot of price movement around. I think Tuesday we had CPI numbers come out and they showed that inflation had really kind of backed off a good bit from the previous month. The markets kind of went crazy. And, then today was the Fed interest rate announcement where they raised interest rates by 0.5%, which, in a previous episode, we largely covered Jerome Powell's comments, prior to the silent period of the meeting where he pretty much said, yeah, we're raising it at 0.5%. Things are looking better, but we still got a long way to go. He raised it at 0.5%. In the Q&A, he was quite hawkish on the prospect of everything moving forward to kind of say, hey, we're definitely not out of the woods. The market sold off pretty strong after that. There was a pretty big pop, just as the leading up to the rate announcement. But it didn't really crash, which I thought was kind of interesting. It kind of gained a little bit of support, not too far from where we were the previous day. So I don't know. It kind of felt like a big whole lot of nothing burger. But I don't know. Do you have any thoughts on that, Viper?
Yeah. I mean, I saw it the same sort of way. Obviously, yesterday we got volatility out of it. And then even in the Discord, we were chatting and talking about how, I don't know, like 2 volatile days on in a row back to back didn't seem. I mean, I don't want to say it didn't seem likely because now we have the power of hindsight, but it just seemed like that was asking a lot. And so, sure enough, like you said, there was a still volatile reaction, but it was much more subdued. And possibly just indicating, like you said, that the reality struck it, so that the reality set in. So pop yesterday, today, reality setting in of like, this isn't getting better per se for a while. So, to me, it was more than anything just a proper pricing in, I think, than yesterday. With yesterday's reaction, while it seemed euphoric, maybe that's too strong of a word, but today then was just confirmation of nope, we're where people expect it to be right now.
Yeah, it's real interesting. I kind of agree. I think it'll be kind of fun the next month and a half because actually the Fed doesn't get back together until early February. So there'll be quite a bit of a period before there's another opportunity for rate changes and things like that. So everyone's going to be paying a lot of attention to interest rate numbers, wage numbers, things like that, because effectively what Powell was kind of saying is, yes, interest rates are coming down, but he seems much more concerned about seeing that come down again and again and again. And also, he hasn't really seen any loosening in the labor market as far as wage inflation and stuff like that goes. So it'll be real interesting what kind of data points come out between now and the next Fed meeting to support some of that. The bond market is incredibly inverted yield curve. And what that basically means is the yield curve is the interest rate as you go from short term to longer term. And normally you have a positive yield curve where your longer term rates are higher than your shorter term rates. Right now we have the opposite. Our short term rates are higher than the longer term rates, and that's what's known as an inverted yield curve. And the bigger that distance is from short term to long term, the bigger the spread, as they call it, in that inverted yield curve. And I believe right now it's about a 0.8% spread, but it's just getting bigger, which is a great indicator from the bond market that there is bad times or tough times to come, because what they're forecasting is they're basically saying, hey, on the 10-year, which is usually the longer dated treasury that they look at, they're pricing in lower interest rates, which basically is them suggesting, hey, look, the interest rates and stuff are too high now. The economy is going to contract and the Fed's going to have to lower interest rates. So it's kind of like a forward-looking thing. So it'd be interesting to see how that stuff plays out. I have like zero experience in this. And so you're basically just getting my, I stayed at a Holiday Inn last night viewpoint on that. So take it for what it's worth. But on to more interesting things, or maybe you consider those things interesting and you're like, no, don't jump to anything else. I'm interested, but that's the extent of my knowledge. So we cannot visit this any longer. But let's hop to our 1% challenge, because let's give some updates here. This is where we stand. Like I mentioned, we had the Coles play. It's still on. It's still ongoing. It's not looking good. I lost a little bit more on that, so now I'm down $43.50 on that trade. Still got a little bit of time left. I'm down 140%. Oh man, look at that, Viper. I gave you credit for I'm going to fix that before next week. That was my trade, that second one that actually is done and over. And then the last trade, Viper, you were putting on basically during last week's show. Yeah, well, you actually put it on at the last week's episode market hours days before the show at the very last minutes of the market. You got stopped out of that one. So, that's coming in at $1.02 loss, which was about a 1.38% loss. I think we're going to talk a little bit here about some of your experiences, but that's fresh. You didn't last very long. This is 2 days and you got stopped out on your stop order. So talk to me about UMPQ.
Yeah. That's why we set up the play like we do with mitigated loss and, understandable defined risk and whatnot. So a couple things. If we jump over to my chart real quick and just kind of decompress or debrief here what exactly happened. I'll jump to the 4 hour here just to get a little more granularity, but don't need to spend a ton of time on it. We can see the purple line is where I entered, and then this little wick here is when I got stopped out. Then we did come back up above entry again. I was like, oh man, I just got wicked. Like, whatever. But then bump, and then we came back up. We retested this 1825 here, rejected off that, and now whatever happens next, my initial entry thesis is completely broken. So I'm moving on. But there was a couple things that I thought were interesting. You remember on my screener, I put in a technical metric of if it was crossing the 200-day EMA. So if we bring the 200-day EMA again, the reason it pinged on my screener was because we crossed it right here on our way down. The one thing that I didn't consider, and there's certainly debate as to whether or not it, is worth considering or not, because I agree the fundamental setup was here, and I did make an aggressive entry. So I entered up here at 1855 before we were hitting the top of this range that I had defined here. And so I didn't wait for too much tinkering around to see what was going to happen. I didn't wait for too much confirmation. I just kind of jumped in and went. So that's one lesson, which it wasn't bad. The TA was here, so it wasn't completely reckless or out of line, but it was aggressive. And so I needed to register that in my mind that I was being aggressive. Therefore, my stop was aggressive, and that's why I got tripped up on this wick. If I had waited just to get confirmation, maybe I would have entered on this body here as we closed this candle at 1840, and I would have had a little bit lower of a stop. Still, obviously, would have been stopped out, but paying attention to the direction it crossed the EMA is, for now, I'm going to make a note of that. because this is all about repeating a deterministic recipe and only tweaking very carefully. And that is to say, one thing does not make a data point. So I need to tweak carefully, but I think it makes sense that if I'm going to trigger on crossing the EMA, I need to consider the context of how it crossed. If it crosses to the downside, everything we know about the EMA is that potentially means a trend reversal. Obviously, TA says we already confirmed our trend reversal up at the top when we did this little failure here. That was the technical reversal, but nonetheless, for my new plays, I'm going to pay more attention to how we cross the EMA. I can filter that screener on if we crossed above or crossed below, but talking to Sprocket, that may not be necessary to use those details because it just means if I'm going to long or short, as to whether or not how I play it. So hindsight is always fickle. It's hard to claim anything in hindsight, but if I would have considered the cross to the downside and then looked for a short entry, I'd be looking at probably a short entry right here when we rejected off the 1824, and things would be looking differently. But live and learn, notes in the journal, and then move on to the next one.
Yep, sounds like a plan. Yeah, I was going to say, it did look pretty good, and I guess it's kind of a good feeling that, you got stopped out where you did once you see the price action beyond there, but I imagine it was probably pretty disappointing to get stopped out and then see that what was a relatively large green candle before switching red and later on. But
yeah, and in profit. So, it was like, man, I would have been up on the position again, but I also didn't chase it. That was another firm rule for these trades is don't chase, don't emotionally chase it. There is case to be made to chase it if things set up again, but I decided I got stopped. We're going to just move on and find something else because I have a tendency to get too emotional when something bites me. And even if it's legit to chase it, those emotions, I don't have enough control of those.
Yeah, and this is actually a great example when we actually put this on and you said, hey, this might not really be within the position sizing rules because this is pretty much 100% of what I put in. And I said, well, not really, because you're going to put a pretty tight stop loss. And so, you only lost $1.02. So I think that's a good risk mitigation because when you're playing these kind of swings, you're not really playing the probability of success in your favor. So you could potentially lose more than you win, which means frequency, not dollars. But as long as your risk to reward ratio is good enough, you can lose more times than you win and still have a profit because your winners will be bigger and you keep your losers smaller. Yeah. So that's a key point that you did do in this trade. So,
yeah. And if my napkin math on the spot is correct, if I stick to the 3-to-1 ratio that I think I mentioned on the episode, then that means I need to win. What is that? Like 34% of the time to break even. If I'm running a 3-to-1 loss to reward ratio. So that's for every, like we called out on this play. I risk the $1 to win $3. So yeah, that's a good point of win-loss ratio.
Yeah. So did anything else? Are you reloading? Are you going after something else now? What's up now? Yeah.
So I hit the screener again, and I did throw on just because this idea of crossing to the upside. I did throw on the filter of cross to the upside just to see what that revealed. And so this KC has caught my interest, and we can obviously see the cross to the upside happened right here most recently. So that's good enough. We'll knock that off of there so it doesn't give us too much bias on the trade. What I like here is I've defined this range as a critical range that was lost and needed to be gained and confirmed. And we can see that we gained We retraced. I don't love the PA here of putting in a lower low from the previous low, but we did gain again, and then we did pull back and test and get support. So I'm not ready to open the trade yet, but this is one that I'm certainly watching, and I do believe I will have a definitive answer by next episode or check-in as to what happened. Real quick, what I don't love about entering right now is I'd like to see a candle close above this previous high to confirm a trend reversal. So far, we've just started a swing, but we haven't actually done anything technical to indicate that we're there on the PA. So I do want to see how things play out tomorrow. It's obviously in an uptrend. It might reject off here. If it gets a strong, bounce off of these peaks here, I'm going to be watching it, and I'm going to either look for a current clear and then retrace, and then I'm definitely jumping in because we got the close above, and then we got to retrace. We'll have to play it by ear, and I'll jot down my thinking if it actually reverses right here, because I don't know on the spot exactly how I'm going to play that. So I have my eyes on it is the point, and it's doing the right things to set up, but it's not quite there yet. The cake is still baking in the oven. But this, in my screening tactics, this has piqued my interest to keep an eye on. So beautiful thing in trading view here. We could do add an alert. And now if it does keep going up, I'll get that alert, add an alert down here, straddle it. And now I got my alert set, and I just walk away. And my phone pings me when it crosses, and then I can come revisit, see my notes here, and figure out what to do. So just wanted to call that out to keep in mind. Everybody's working day jobs here. We're not full-time traders, and so I don't want to sit here and stare at the chart. I want the chart to tell me when maybe I need to do something.
Yeah, definitely sounds good. Keeping an eye on that one upcoming. I haven't put a trade on yet. So I actually was looking around, and so I think we can put a trade on tonight, Viper. Let me show you what I've been kind of looking at. It's not every day that you can put a trade on when you record at 9:30 at night.
It's after hours.
But when
and we're not talking crypto.
Yeah, it's not crypto. It's futures, and futures. I just love futures. But yeah, let me show you what I'm kind of looking at. This one, I won't say this exact trade was brought up in the Discord, but one of our Discord traders was kind of saying, "Hey, you really got to check out MCL. I'm having a lot of luck with MCL on things." And I said, I haven't really messed around with a lot of commodities in the futures market recently. I had a very famous episode, the soy disaster, where I lost a good bit of money trading soy, and it kind of is a little scarring. But I'm pretty comfortable in futures and stuff like that. And this MCL is a micro contract of the crude oil. So it is a commodity, but it's a micro size, so it's pretty tiny. And what I've got here up on the trading view is just crude in general. MCL is a smaller contract, but the price is identical. It just is what the future works out to be. And what I've kind of noticed here that I'm calling out is we got these trading ranges, these channels of this downward movement on crude, and they kind of break out every once in a while, but then it resumes this downward trend. And presently, we're in one of those downward trends. And if you'll notice, we're kind of at the upper end of that channel. And that's very similar to that trade setup I had on ES, which is the S&P futures, where, hey, we're on the upper end of this channel. We started to push back off that channel already. So maybe this is time to open up a bearish trade on crude. And that's really where I think we're at right now. And I think it's fits my MO. Just looking at the overall bigger picture of crude, downward pressure, a lot of negative momentum, or a lot of negative feedback on the economy, all that stuff. None of that is good for crude prices. And this is just looking for a short-term trade, or a short-term trend here. Trade trend. Short-term action just off of this top of this channel to the bottom of this channel, which will probably be in the, I don't know, mid 60s, upper 60s. So yeah, let's take a look and see what we can put on. Yeah, Viper, so let's take a look here at Thinkorswim. So I'm going to switch over here to show you a chart. This is a 15-minute chart. This is kind of what I end up looking at just prior to an entry, usually looking to see when's a good time to enter. So right here was our high back around the lunchtime at 77.74. Interestingly, the market closed right here. We got kind of squashed down candles, and these two red candles, this is really funny. These two red candles actually showed up as I was talking to you about the play, saying, hey, I really think we're going to start bouncing off of this and retracing back. And sure enough, here it is. Boom, red candle, boom, red candle. And that was right after I kind of called it out. And I'm like, oh man, we're going to miss the first part of this move. But don't worry, you know, I showed you on the previous chart, we're looking for a move from where we are now down into the mid to upper 60s. So the next thing that I want to look at is switching over to, actually what I want to call out before I switch is on this, if I switch this thing back to daily, just to see where volatility kind of stands, we'll look down here at the bottom, which is the bottommost blue. This is implied volatility. And really what I want to kind of call out is look where this volatility is. Drops all the way down to like 0.39 volatility. And you can see relative to where it's been for the past year, this chart kind of shows the past year, like we're lower on volatility. Now, what that tells me is this is not, we don't want to sell volatility here. It's okay to buy volatility. And that gauge is kind of going back to your comment on, are we going up or down on the EMA? It's, am I playing this bullish or am I playing this bearish? Playing this bearish from the chart look, and then the option on how I play it in options world is, am I selling options or am I buying options? You buy options when volatility is low. You sell options when volatility is high. That's what I do. I guess you can do whatever you want. But in this case, when volatility is low, I'm okay to buy. So let's switch over here and let's take a look at the option chain. So switching over to the option chain, this is going to show you the options contracts as they exist here. And I am going to probably come out here into February. Now, this is one area that I haven't really dialed in because when I'm selling options, I definitely want to stay in the 35 to 45 days to expiration because that's where theta decay really starts to pick up. When you're buying options, you don't really want theta working against you. So I don't know if that's the best time frame to work on or not, but because we're looking for kind of a quick move down, I don't really want to go too far out on my options because if you do, then the price movement is going to be more muted on those levels because there's so much more time. So I am going to go with this February expiration, which are about 34 days out. So we're going to open up that chain. You can see right here, this is about 45% volatility. And if we had looked at that chart from before, if you remembered, most of oil was kind of in the 55% volatility or higher range for the better part of the past year. So, you know, we're below that. So that's why I kind of say we're on the more bottom end of volatility. So okay to buy here. And we're going to want to buy a put. So if you remember, we're at 76 right now. My thesis is we're going down to mid to upper 60s. I don't know how far down we're going to go. There definitely was a level at 70. So let's take a look at this option chain around the 70 strike. So if we come down here to the 70 strike, that is basically about a 23 delta, and I want to buy that. Now, you'll see here it puts down this trade, and this is going to take $300 in buying power. Yeah, that doesn't fit my $100 trade size that we're shooting for here. So cannot just buy a put. If you could just buy a put, here's your profit chart, right? You basically are are effectively shorting it. So you can you go lower, you go higher, higher, higher. There's no limit to the downside on what you can make. However, I can't afford this $300 naked trade. So we need to put a cap on it. So the first thing I'm going to do is I'm going to try to just go out $1 wide. So I'm going to come down here to $69 and I'm going to sell the $69 strike. Now what that's going to do is you can see that drops me into this 24 cents. This is a weird part about futures. I'm not going to try to explain it here. This is a $43 in buying power reduction. This makes it basically $43 here. And you can effectively double it. It's about half, right? So 24 is really like 48. So it gives me about $150 potential on the upside. I'm okay to increase this. So let me do 2 contracts. So now I'm going to actually do 2 of these. You can see it's going to cost me $86. So the potential upside is about triple that. So with this trade, you can see that if oil, these dotted lines are, this middle one is where we're at right now. This is a 10% price slices. So a 10% drop in oil puts us right here in the money. Anything below $68 a barrel puts me in the max profit. Anything above $70 a barrel puts me in the max loss category. And the one thing to remember is because volatility is low, if price is falling, volatility is going up, and my price will also go up. It won't ever exceed this blue line, but this purple line will start shifting into a steeper and sharper curve. Viper, any questions that you might have here? That I kind of ran through that pretty quick before I actually put the order in to kind of show what that is.
I think I followed it. I mean, this screen to me, I still struggle with on just about any play. And but I haven't put my finger on exactly why.
Yeah, it takes a little bit to kind of get used to. And it gets even more confusing because it's all kind of time bound a little bit. But effectively the blue line is at expiration. So this thing is February expiration, which is really like a January 30th contract, whatever. On that date, this is the exact value that the options will have right on this blue line. This purple line is basically the value that they have today. And that includes extrinsic value. At expiration, there is no extrinsic value. While it's in there, that kind of fluctuates based on volatility and where the price is and what the delta is. The key point that I want to call out here is that options chain that we looked at, so you can know what strike is what. The puts are on this side. This actually calls out your probability of being out of the money. So this is actually a low probability trade. This trade really only has about a 25% chance of max profit. I'm okay with that because I'm going to get out of this thing before max profit. I'm not taking this to expiration. I'm basically going to play this until oil falls back down, and I can ring the register for a profit. I don't know the magic number that I want to dial into. The last one was about 100% profit when I rang the register. I'll probably follow a similar thing. If oil does not go back down, I will ride this thing to the end, hoping that it will dive. So the exit strategy to the loss side is take it to expiration if it never moves your way. If it does move your way, take your profit at probably is going to be 100 to 150% is probably my profit target on this. We'll see. We'll see how it goes. But that's kind of the movement here. And then the other key point is I'm putting both legs in the same order. And that's what makes that vertical. So I'm buying one option and selling another, which basically tells me my max risk is only in that period between those two strikes. So my riskiest, area or the area of fluctuation is between $69 a barrel and $70 a barrel. Below one is max profit, above the other is max gain. And that placing that vertical is what can shrink your buying power and position size to keep your risk managed. So in this case, it's, $43 a contract. I can afford 2 contracts, so I'm going to play 2 contracts. All right, Viper, let's fire the order and see what happens. So what I basically do is this is all like a draft order. And when I want to send it away, I say confirm and send. And this thing is going to bring up my order confirmation dialog. And on here, I can do a quick check here. It says, hey, your max profit is going to be $152. Your max loss is $48. So, if this thing goes against me, I'm out $48. If this thing goes in my favor, I can make up to $152. That's not going to change. They talk about how much buying power this is going to cost you. This is basically your capital risk, or what they're going to hold in escrow for you. And this is where anything would jump out if you accidentally put too many contracts. You'd look at this and go, what? Max loss is $15,000. You might have put too many contracts in. So this is kind of your check. And this says your break even is $69.76.
And hold yourself accountable. If you see max profit at $15,000, don't just push the button.
Yeah, hold it back, because your max loss is probably not $48 in that case. So one thing that I kind of like to check around a little bit when it comes to maybe the price fills, because after hours like this, while it's trading, they can be a little bit spotty on fills. And so I like to try to get a better fill. So I'm going to actually go to edit here. And this is going to bring up the order entry. And then there's this expected price. And this is where you're going to get a little movement here. So this is going to give you the mid price and then the natural price. Natural price pretty much says this is right at the ask and bid level. So this is like you will get an instant fill if I say I'm going to float this order out there for 33 cents. What you want to try to do is get a little bit farther away from the natural price. So the mid price is just, the division between the bid and the ask, and it's right in the middle. And sometimes what I try to do is get a little bit better of a price by kind of adjusting this thing just a little bit, and says, hey, can I get this filled for, 21 cents or 22 cents? And so I can actually put the order in. It's telling me that's below the mid price. So it might not get filled, and that's okay, because I can then walk the order up from there. So I'm going to say confirm and send. And so again, brings up that same confirmation screen. And right here, jumping out, oh my gosh, this is not the order I want to make, because I want to do 2 contracts, and this doesn't have 2. So let's go back to edit, because I flipped this thing around. I lost one of my contracts, and that's why you look at them. So now I'm going to do 2. And I'm going to say confirm and send again. And we're going to try to get this filled for 21 cents. I don't think it'll fill. That's pretty far away, but we're going to send it anyway. Okay, so what you can see here is this is my order waiting to be filled. It says, hey, you're willing to pay 21 cents, but right now it's trading for 24 cents. So you're not getting filled. I always float a lower order out just to see if a market maker comes in and bites it. They're not. So what you can do is you can right click, you can say cancel and replace. Cancel and replace will bring up same dialogue we were just at, and I walk it up a penny. So now let's try to fill it at 22 cents. Confirm and send, everything checks out there. Go ahead and send the order. You get your canceled notice that says your first order got canceled. Your other order is going. Let's take a look. It says, hey, you're asking for 22. I'm filling at 24, not getting a fill. Let's go ahead and walk it up another penny. Cancel and replace. And this is how I try to get a better fill. So now I'll walk it up to 23 cents. Put in my order, 23 cents, looks good. Put it in, order canceled. I'm now trying to fill at 23 cents. Again, not getting filled. And this is what happens when you have a really wide market. You kind of just keep walking up until you get filled, and then you have better confidence that, hey, at least I got a better price. So I'm going to walk it up again. Now I'm hitting the mid price. I very well likely will probably get filled at the mid price, I think. Boom, filled. So right there, I got my fill, got my 2 positions in, actually filled both contracts. I'm in the trade. Viper, we're on our way now. Another 1% trade in the books.
It's happening.
Viper, that's it. That's a review of where we are in the 1%, taking you through live action, putting trade, filling it. I'm always envious of those shows, the other YouTubers that are, constantly trading, during market hours, and you can see all the action happening live. I don't know that I ever get to do that because my day job, every time I have a day off from my day job, it's always a holiday. So then the markets are closed. So it is kind of exciting to be able to put an order on when there's actually market action happening. Maybe that's one of the reasons I love futures, is because they're kind of going 24/6, I think is what they kind of go. They go Sunday night to Friday night. So anyway, a lot of action out there happening in the market. Hope you guys find something that you're trading. Hop in the Discord. Let us know what you're trading. We're going to keep you apprised of all of our 1% plays, see how they all pan out. I got to correct that thing because we'll keep a little track record there to see how Viper and Sprocket do on the total hauls overall after we run this for a while. But have fun out there. Holidays are coming. They always tell me a Santa Claus rally comes every year. It happened last year. Will it happen again this year? I don't know. Only one way to find out, and that's to be in the market. So good luck out there. And remember, think outside the block.